Hi, welcome to another video in the ASA level managerial accounting series. This is the fourth and the last part of the standard costing series. So if you've not watched the first three parts, please watch them. This is just a final conclusion where we will be doing the reconciliation of the cost and profits. So we've already covered all these variances. The sales variance we covered in the part 1, the material and labor cost we covered in part 2, and the variable overhead and fixed overhead variances we covered in part 3. So let's go ahead with the reconciliation between the standard costs and actual cost, and also the standard profit and actual profit. What I have in front of me here is the numbers or examples that I've used in the last 3 videos of standard costing. I've compiled them here and we will see how to do the reconciliation. So in the budget column, you'll see output 300 units and revenue, material cost, labor cost, variable overheads and fixed overheads. Basically this is the management's estimate, or basically standards set by the management for that for 300 units of output. This has to be the revenues and cost, and at the end, according to them, the profit earned should be 5,400 if the organization produces 300 units. But actual numbers here show that 400 units are produced by the organization. Fine. And then actual revenues and costs are given, and then at the end, actual profit turns out to be 5,200. So there is a variance. We need to calculate the variances here. In all the videos I've told you to calculate the variances, or before calculating the variance, you have to first calculate the standard data. That for at the actual output, using the management standards, what should be the revenues and cost. So let me show you the standard data here first. So for 400 units of output, based on the management standards, or proportionately, what we've used for budgeted, proportionately, if I apply that on actual, this is what I get. Revenues, material cost, labor cost, variable overheads and fixed overheads, and at the end profits should be 7,200 if we produce 400 units. That's what the management feels. Now next, what I'm going to show is, I'm going to show you the calculation of variances. We've already done these actually. For the same numbers, we've already done the calculations in the last 3 videos. I've just compiled it here. So the variances, if you see, have been calculated here. And also what we did in the previous 3 videos, we calculated the sub variances under each variances. So let me show you that also. For example, revenue was 11,000 favorable variance. What is the reason? So sales volume 15,000 and at favorable, and sales price 4,000 adverse. Same way for all the cost and revenue variances, sub variances have also been shown here. Now fixed overhead volume variance 27 adverse. We had also divided this further into fixed overhead capacity and fixed overhead efficiency variance, but I've not done that here. Let's keep it simple. But once you understand the logic of reconciliation, you can use that also. Now what we're going to do next is, we are going to reconcile the standard cost to actual cost. Basically, as per management's standards, the standard cost, or the total cost for 400 units of output, should have been material 12,000 plus labor 24,000 plus variable overhead 6,000 plus fixed overheads 10,800, which brings us to total of 52,800. But actual cost were different, and total of the actual cost is 50,800. So here there's a difference of $2,000. We will be reconciling this 52,800 to 50,800, and we'll be using these variances. We will be adding and subtracting the variances to, let's say, the standard cost to arrive the actual cost. So let's begin. We'll be using first the format to the left. So let's begin with the standard cost, which was 52,800. We need to add the variances and subtract some variances in such a way that at the end we are able to calculate our actual cost. How do you decide which variance to add and which variance to subtract? See, let's talk about, let's say, material usage variance, which is 1200 favorable. When will a variance be favorable? When actual cost is less than the standard cost, because then only the profits will be higher if actual cost is less than the standard cost. So if I talk about a favorable variance, favorable cost variance, which is material usage here, 1200 favorable. What should I be doing with the material usage variance here? If I'm starting with the standard cost and I have to calculate my actual cost, I will have to subtract the material usage variance. Why? Because when material usage is favorable, it means the actual cost is less than the standard cost. So starting from standard cost, if you have to arrive the actual cost, you will have to reduce the material usage variance. So let me say material usage 1200 favorable. Next one, we have material price variance, which is 18,000 adverse, sorry, 1800 adverse. Now, when will a cost variance be adverse? When the actual cost is higher than the standard cost. So if I'm doing a reconciliation starting with my standard cost and I want to calculate my actual cost, I will have to add the material price variance, which is 1800. Same thing I'm going to do for all other cost variances also, labor, variable overheads and fixed overheads. So let me just write it. I have the numbers here in front of me. So we also had a labor rate variance which was adverse. So 1000. Basically all the adverse variances I'm going to add here. Then I had variable overhead expenditure variance 2200. Then fixed overhead expenditure variance 1900, taking the total of all four outside 6900. Then I'm going to deduct the other favorable variances also. Under that we had labor efficiency 4000, then variable overhead efficiency 1000, and finally fixed overhead volume 2700. If you are breaking down fixed overhead volume into further capacity and efficiency, then you will not write fixed overhead volume, you will write the subparts of fixed overhead volume. But here we have not broken down, we are keeping it simple. Taking the total of all the negative numbers outside, we get minus 8900. Now when you calculate the actual cost, starting with the standard cost, so 52,800 plus 6,900 minus 8,900, we get our actual cost of 50,800, which is equal to the 50,800 that we've calculated here. So what does it mean? It means even if you're not given the actual cost, but you're given the standard cost and you're given the variances, you can arrive at the actual cost by adding and subtracting the variances in a correct manner. Now let's do the same thing with the profit reconciliation. Our standard profit was 7,200, but actual profit was 5,200. So what we're going to do here, we're going to go to the right side of the format. Standard profit. $7,200. So we need to add and subtract the variances in such a manner that we can arrive at our actual profit. Now in our cost variances, what we did, we added all the adverse variances and we deducted all the favorable variances. Why? Because adverse variances lead to higher actual cost compared to standard cost, and favorable variances lead to lower actual cost compared to standard cost. But in case of profit reconciliation, it's going to be completely opposite. We are going to add our favorable variances and we are going to deduct our adverse variances. Why? Because of favorable variances, the actual profits will be higher than the standard profit. So if you're trying to calculate the actual profit starting with your standard profit, you will have to add all the favorable variances and deduct all the adverse variances. So all the favorable variances here in the left side, I have under the less or the deduct area. So I'm going to shift that to the add part here. So add material usage, labor efficiency, variable overhead efficiency, and fixed overhead volume. Okay, let me take the total later. Under less, I will write material price labor rate variable overhead expenditure and fixed overhead expenditure. Now, the only difference between cost and profit reconciliation is that when you are doing cost reconciliation, you will only take the components of cost, basically the four heads of cost. But when you're doing profit reconciliation, you also have to take into account the difference in revenue. Why? Because the revenues also affect the profit. So when I look at the revenue, my overall revenue variance is 11,000 favorable, but that is divided as sales volume 15,000 favorable and sales price 4,000 adverse. Now if I talk about sales volume variance, what is that? It is the variance in the revenue because of difference in quantities produced and sold. So here the management budgeted 300 units but actually produced 400 units. The extra 100 units produced and sold, that led to a favorable variance of 15,000. But when I'm doing my reconciliation between the standard profit and the actual profit, isn't the output under standard and actual the same? 400 units and 400 units. So when we are reconciling our standard profits and actual profits, the sales volume variance is not going to affect the reconciliation, or we will not take into account when doing the reconciliation between the profits. We will not take into account the sales volume variance. Again, why? Because the outputs are same under both standard and actual columns. Only if outputs were different, we would consider sales volume variance. Now the sales price variance, yes, we are going to consider because the difference in selling price has led to changes in revenue and that has led to change in profit. Now the sales price variance here is 4,000 adverse. So we are going to go down here and under the less part, we are going to say sales price 4,000. So taking the total of all the add items, 8,900, and taking the total of all the less items, 10,900 minus. When we calculate our actual profit, starting with our standard profit 7,200, add 8,900 and deduct 10,900, we get 5,200. If you compare this to the profit from the data, yes, it is 5,200. So that means we've completed our reconciliation properly. So I hope you enjoyed the entire standard costing series. Since the topic is really vast, I had to break it down into 4 videos. Make sure you watch all the videos, then only you'll get a good understanding about standard costing, and you'll also have to practice questions simultaneously. Just watching one example or one series of videos will not make you better at any topic. In fact, standard costing is even a difficult topic, so you'll have to practice more questions and get used to the exam style questions. So please like the video, please share the video with your friends. Don't forget to subscribe to the channel. I'll see you soon in the next video.